Hello and welcome to this special conversation with the Governor of the RBI, Dr. Raghuram Rajan, a day after he presented yet another review of the monetary policy. Dr. Rajan, thank you so much for joining us on Bloomberg TV India. We're talking at a time when there are worrying signals that are emerging from the globe. Currencies have collapsed, and some would argue that they've gone to near 1997 levels or perhaps even below that. There's a rout in the commodity markets. Commodity surplus countries, those who have depended on that, are in a very bad scenario. Given all of this, how bad is the global scenario? Are you concerned with the signals and the data that's coming from all across the globe, sir?
Well, global demand is still weak. I think that's the obvious reason why we're seeing some of these developments. At the same time, there are pockets of strength. The US seems to be coming back once again. Japan has been growing moderately for some time. The euro area has been getting over the Greek crisis. And there are areas of the euro area which are starting to grow reasonably rapidly. So it's a mixed picture. I think the concern is 7 or 8 years after the crisis, we are still in this situation of relatively slow growth. And of course, the emerging markets, I think, now have more serious problems than some of the industrial countries. There's a lot of concern about Brazil, Russia, and now increasingly what's happening in China, whether the stock market gyrations are a signal of something deeper that's
and the unusual
happening.
Intervention by the government there.
And the intervention, of course, nowadays governments and central banks seem to be intervening everywhere. So the old maxims of don't intervene seem to have been thrown out of the window. It is certainly from India's perspective a source of concern because we see it in our exports. Export growth has been, even correcting for the lower prices, has been slower than we would want. Again, pockets of strength, countries of strength. I mean, exports to the United States still seem to be growing. But in other areas, for example, exports to the euro area, very weak. So mixed bag, it could be much better.
Is India immune? Because I'm trying to sort of understand what you just said about the impact on India, and that's what we are really concerned about. I remember at the last financial crisis, months before that, the tone and tenor of what you heard from at least Delhi or the policy establishment was markedly different from what really happened a few months down the line. Your global expertise, sir, and your view of the signals that you're reading, should we be concerned? Or are we just kind of complacent about, because we have a relatively stable currency?
We cannot be complacent, and paraphrasing John Donne, no country is an island. We are all sort of connected. And typically the connections come up in ways that you didn't think of before because we don't see the connections ex ante. That said, we do benefit especially from the fall in oil prices and the fall in some other commodity prices. We do get hurt, for example, in the fall in rice because we're the world's second largest exporter in rice. But some other commodities we benefit. On net, I would say certainly the weakness in global demand hurts us, but there are offsetting benefits such as commodity prices. Given the possibility of turmoil, especially as the Fed starts normalizing, again, it's one of the most widely anticipated events. Hopefully, everyone is prepared, but you can never rule out the possibility of volatility. In such a situation, I think India is one of the better prepared economies, partly because we have focused on macro stability, bringing the fiscal deficit, current account deficit, inflation, all these things down. And partly because we've tried to keep out the short-term flows, and partly because we have larger reserves than in the previous instance of turmoil. That said, it would help if we could get more clarity on some of the reform measures that are taking place, because that would send a strong signal to the outside. Legislative action, for example, on important bills would be very useful.
Good point that you raised, because that was one of the questions I had in mind. There's been a strange reversal of sorts from a situation where the land bill was something that was a signal to corporate India that some of the difficult points as far as land acquisition is concerned are going to be dealt with. We now see a U-turn, and while it's the politics of it which I'm not putting in front of you, both on the GST, sir, as well as the land bill, two cornerstones, two pillars of the government strategy so far, they seem to be coming unstuck. And the world really doesn't know what to make of it. Corporate India doesn't know what to make of it as far as project outlooks are concerned. Is this a worrying point, or is this politics as usual, sir?
No, look, there are important parts of the government agenda which are essential for our growth going forward, and it's important that over time they be addressed. Now, I do think these are difficult legislative actions. The GST is a constitutional amendment. The land
not
bill,
happening next year too, sir?
Well, I don't want to opine on when it's going to happen, but the land bill also is, in a sense, an amendment of a bill that was already passed by Parliament, and therefore requires a number of parties to get together to rethink.
Which is not happening, sir. That's my point, sir.
These are important legislative elements. My simple point is that from the external perspective, it would be good if there could be some progress on these, because that would send a strong signal that India is on the move. I'm not saying it's not happening is a disaster. India works at its own pace and things happen over time. But the simple point is that this would send a strong message to the outside that India is still on the move, which is very important in times of turbulence, to send the signal that we are a safe haven. There's a lot of flows that have come to India in the last year or so, anticipating that exactly. India will stand out. And I think that story is still live. I think that story takes time to build together, but every step helps. And legislative action would be a step forward in immunizing India to the external side. But I don't want to opine on anything more than that. Okay. It would be helpful as an economic move.
Okay, precise point that you made, and one quick last follow-up on that before we move on. This thing about export weakness, what's happening in currencies, all of that is playing out as we speak, and there perhaps is therefore a question mark as far as our manufacturing-driven strategy is concerned. You've commented about that in the past. Can I ask you to sort of recap that or offer us a fresh perspective, if you have, as far as that entire issue is concerned? Because a lot of focus from the government, apart from the legislative side, has been to get these companies to manufacture, sir.
Well, we are seeing manufacturing successes in India. I mean, I don't want to take specific names, but take the entire auto ancillary industry. Take the fact that auto exports are happening. Autos are
and local demand is also coming.
Local demand is happening, but auto exports are also happening. And autos are some of the most competitive areas in the world, and we're succeeding there. So I think that there are absolute possibilities for export. The problem right now is to some extent of weak currencies in other areas also, which make it harder to export to some areas versus the others.
Can anything be done to offset that?
It's hard because it's specific areas of weakness. It's not an aggregate weakness. So the dollar, for example, is very strong, but the euro is weak, as is the Japanese yen. So given these two areas, it's hard to cater your export strategy to particular areas. I think the key
nothing needs to change on the currency management side.
Well, it's not that you can pull a lever up and down and say today the currency goes up this much.
A lot of people believe that the RBI governor actually has those levers.
Well, I hate to disappoint them. We do have the ability to intervene in the currency for a while to reduce volatility. But we don't want to get into the business of trying to maintain the currency at a particular level, which is different from the level the market wants it to be at, because that will involve countries that have done that have had enormous amounts of financial repression in the economy, enormous amounts of financial control, because you have to be able to tell, don't do this arbitrage, don't do that arbitrage, stay out of this, stay out of that. That in a world which is very connected, which is where we started, it's much harder to do that. And so, rather than get into this thing, which doesn't necessarily pay off in the longer run, you create distortions in the whole economy. Better to try and avoid volatility where you can, but let the currency find its level.
Okay, sir, and perhaps September will be the time when more will be said on that subject. Let's move on from there to another cause of macro concern, so to say, and this is to do with NPAs. I recall when you moved from North Block to Main Street 2 years back, perhaps one of the first statements that you made, and I hope I sort of recall correctly, was that no promoters have a divine right to be in management of their companies. You were obviously sending out a very, very strong signal. Yet, sir, 2 years down the line, can I argue before you that despite you being very clear-headed on that, nothing seems to be happening on the ground? As far as managements are concerned, people seem to be getting away with a lot of bad numbers, and now you also have a restructuring option that has been provided, which some people say is being abused.
Yeah. First, I keep. Let me reiterate that there are good promoters, many of them are good, and there are some bad apples. And the point was that bad apples don't have the right to run their companies into the ground and expect to continue to be in charge. Okay, that they are equity holders, and debt holders should have the ability to call time out for them.
But that hasn't happened, sir.
Well, it is happening. It is happening increasingly, and with the range of powers that we have now given the banks. A number of banks are, for example, writing into their contracts the ability to take equity when the promoter gets into difficulty, and thereby getting the right to excise the promoter. So it is a change in the system, the way the system thinks. For a long time, the system has been excessively friendly to the equity holder vis-a-vis the debt holder. Now the balance is slowly turning and becoming more appropriate. Now you mentioned NPAs, you mentioned sort of improper restructuring. There is always an attempt to avoid what I call forbearance or kicking the can down the road, pushing the problem into the future, evergreening. That's one possibility with bad loans.
Can I interrupt you there, sir? Without taking names, of course, recent cases, the can being kicked down 30 years down the road. Not the current promoters, but even the next generation gets relief, large sums of money. A lot of people are saying, what's going on? Because, you're in a country where headlines are written about bad policy like a farm loan waiver, yet corporate loan restructuring, very sophisticatedly worded and put out, better communications, but at the end of it, a major issue.
If you have a long-term project which is going to pay off revenues for a long time, say a road project, okay, then having a debt structure which extends with the idea that it will eventually get paid over 18 years or 17 years is not inappropriate, provided the interest is being served all along the way and some principal starts getting paid along the way. So what you're doing is smoothing out the principal payment. I presume what you're referring to is this 525 structure, which is very much in the news. A lot of banks have been petitioning for a structure which allows them to have maturities which correspond more to the maturities of the projects.
But these were the banks themselves responsible,
Exactly.
sir, and you have nominees on most of the public sector banks, for instance.
Exactly. So the banks themselves had the ability to do this before, but for a variety of reasons, they thought they were not permitted to do it. Now they have moved to a structure where, for some of these companies, only for the core sector and infrastructure, where this sort of repayment schedule can actually be supported. Now, we have been monitoring this process. We've asked banks to come back and present some of the cases which we choose and look into what is going on. And so we are also keeping an eye on what is going on to make sure this doesn't become a backdoor way of evergreening. Now, there are some constraints which have been put on this process. For example, the NPV of the project should not change. Okay? For example, if you have more than 10% cost overruns, you cannot do this. So there are a variety of checks and balances in place. What this will ensure is a more reasonable time frame for payment, but we're also asking banks not to push out the payments far down the line. Don't start putting in large moratoriums in here. Let the payments begin, let the repayments begin. Interest, of course, has to be paid. And just make sure that the structure may be a little more better suited for long-term projects. That is what we call flexibility. Evergreening is when you create the structure but give the guy loans to make the payments, etc., etc. And we're looking into situations where that may appear to be the case and questioning the banks to make sure that's not the case.
Because, there are companies, again, without taking names, $12 billion of debt, market cap is $500 million. How realistically would that company ever be a going concern, and why should it sort of get...
So the truth of the matter is, in some cases, these guys are so thinly capitalized that ultimately the debt holders will have to take over. The banks have been reluctant. This is where the SDR structure comes in. They have the ability to take over the firm then. Now, then they will have to recognize whether in fact they can get fully paid or they'll have to write down the debt.
But are bank managements responding to what you're saying? Because clearly the architecture has been laid out. Even the legislative amendments have been meaty. You yourself have always spoken about it very clearly. No one can say that the RBI is kind of being,
The banks are working very hard. I would say there's a sense of urgency. Now, in some banks, unfortunately, for some time, heads haven't been appointed. I'm assured that this is going to happen very soon. But a number of banks, I can take a few names. The CEOs have been working very hard, have been pushing promoters to sell if they don't have the money, to bring more money in from other places. They're working hard. Now, I'm not going to say there's absolutely no chance of any aberration. There will be in this process. But what we have to do is make sure the system is working in the right direction. And with the help of our large loan database, which identifies early warning signs of a loan getting distressed, with the bank managers being brought on board, and them starting to take action sooner and take more drastic action, I think we're moving in the right direction. Can more be done? Of course. We called the banks, we called the ARCs, we called private equity in last week to talk to them to figure out what more needs to be done. We ourselves are looking at some of these cases. We called for presentations. We'll come out with some tweaks, some changes. But I think most of the instruments are already there, and we've given enough flexibility. Let's see how it moves.
Quickly, sir, what is the percentage of results that has been achieved on this front? If you were to describe the problem on a scale, the NPA problem, where is it at?
It's a very easy question, very difficult answer. I don't know where I would say that we are making progress, and I can't say I have hesitated to say we are past the peak. We have to see. We may be past the peak, but let's see.
Okay, let's move on to interest rates, and perhaps the wrong question to ask a person like you with your stature and the mastery of the science that interest rates are all about. But from a very sort of outsider perspective, I'm asking you this. Beyond 25 basis points, beyond inflation, beyond all the 3-4 key things that you look at, the broader picture, and this is even in response to yesterday's development, we had industry lobbies come out with the same sort of commentary. But the larger point really is, and perhaps you might agree with me, sir, is that as far as the reality is concerned, the harsh reality is that interest rates are high as far as new investment is concerned. That's what a lot of companies tell us. infrastructure is therefore at risk in some ways about new projects, and therefore you're also putting a question mark, not you in person, but in terms of the debate about where will growth head. Do you think that as far as the issue of interest rates are concerned, there is also art that is involved, and we perhaps seem to be missing the point as far as that is concerned?
Well, this is the old criticism that what we do is we look at one model and we say this is therefore what the model spits out, and why have a governor if you can have a model? So why, the governor is supposed to take many things into account. I think people who make these comments don't understand the depth of the discussion, the thinking that goes into this process. We are in a difficult situation. Now, by the way, a lot of people complaining about the high interest rates are often complaining about the spreads relative to the risk-free, which I'm being charged 13.5% by my bank. Well, 6.5% of that, or 6.25% of that is a spread from the risk-free, right? Because of your risk, because of your reputation, because of the difficulties your group is in. It's, home loans today are what, 9.7? Many companies will be happy with 9.7 as the borrowing rate, but they're not getting that. That's not because the policy rate is high, it's because the spreads are high. And to talk about the spreads, they have to ask why they've got into the state, why they're in such difficulty. Given where inflation is, let's say we reach our target of 6. Let's say 6 is approximately where inflation is now. 7.25% as the policy rate means it's 1.25 real rate. I challenge you to find 1.25 as a high real rate anywhere in the world, right? Well, then people say, oh, no, you're using the wrong, you shouldn't be talking about CPI index. CPI is
Which is what the finance ministry seemed to suggest. Well, just a day before it said you shouldn't only be looking at inflation.
Well, what else do you want me to look at? If you've given me an inflation target, what do you want me to look at? No, but CPI inflation is different from WPI inflation. So people say WPI inflation is what matters for industry. For some industries, it does. I mean, yes, steel has, you're seeing price deflation. But you're also seeing input costs lower, right? So what matters from an industry's perspective, investment, is what is going to be the inflation in profits, which essentially is what is the difference between the inflation in revenues and the inflation in costs. And that is not as low as the WPI numbers say, because you get a benefit on the cost side, even while you don't get much benefit on the revenue side. Your costs are going down, even though your revenues are going down, the net effect may actually be going up. And you see that in some of the numbers that companies are declaring. Profits are actually going up, even though the top line is not growing that fast, right? So that's something else to keep in mind, that I think there are distressed firms in the economy. Don't get me wrong. There are distressed firms that are highly over-levered. But monetary policy can't be targeted at those firms. Ignoring the saver who has had 4 or 5 years of negative real interest rates and saying, now that they've started actually saving more in financial savings, we should turn it all around and start going back into negative real interest rates. We can't afford to do that as a country. That will then mean, again, large current account deficits, etc., which we just came away from. So we have to be a little careful. It is a balancing act. All the thinking goes into how do we balance these things, keeping in mind that we need to bring inflation down. Ultimately, that goal of bringing inflation down will bring everybody together. Will bring the producers together, the investors together with the savers. Because with low inflation, nominal interest rates can be low. Doesn't matter where WPI is, CPI is, they both will be pretty equal.
For the current near-term scenario, does it also mean that the easing cycle is over for now?
I think the policy said it all yesterday, that it's still accommodative, and that as and when room builds up, we will look to be more accommodative. I can't say it better than that.
Okay, sir. The final point really, and this is to do with the debate around the Monetary Policy Committee. You said it very clearly, but I'm going to sort of ask you to once again put it in perspective. Broad consensus reached. You have indicated that if the veto goes, you have no issues. Former Finance Minister weighed in on this and said there should be a casting vote. The finance secretary has spoken about it. For the markets and for everybody who views India from outside, this is a very, very significant issue. And this is about the independence of the regulator. Are there concerns out there? Are there things that sort of keep you up at night and are worrying you about the way this MPC debate is evolving?
No, look, I think right from the beginning, after the finance minister announced that the MPC would be set up in the budget speech, to set up the MPC requires a change in the RBI Act. Okay, so it first requires a discussion as to what the change will be, and requires a consensus to be reached between the government and the regulator. That has been reached. Now it has to be written into legalese, then Parliament has to take a look at it, and then Parliament has to opine on it. I presume there will be issues of the details and so on, and parliamentary processes on that. So given all that, I think government wants to choose a time when it can announce, and of course, as I said, the I's have to be dotted and
the standing committee will come into it.
Lots of things could happen. I'm not an expert on this process. I don't want to talk about what is necessary. Therefore, I think there is some way to go in how this plays out. But as far as the broad understanding goes, I think we are in a good place.
Okay, without getting into the details, which obviously you cannot, and ultimately it will be Parliament which will make the law, should the markets worry about things like, oh, is there equal representation for the RBI staff?
Look, I think the RBI, understands its mandate.
Does the government understand that?
And the government fully understands, because we discussed the mandate with the government. So I think that this committee, if the final sort of structure looks like what was agreed, of course, again, as I said, Parliament can opine on it, completely meets all the necessary requirements that are laid out in the 3 or 4 conditions yesterday. And therefore, I don't think anybody should be worried about monetary policy making going forward if that is indeed the structure.
What is the timeline likely, sir?
You have to ask the finance ministry.
Okay, there are a lot more questions that one could have asked, but Governor, thank you so much for taking out time today to discuss issues of relative importance. And like you said it, the debate about interest rates cannot be seen from just a simplistic manner. All the very best for the next policy. Thank you so much, sir.
Thank you.